Right, did you know you can lose on 70% of the trades, win on 30% of the trades, and make an 80% gain? Do you know that? We'll show you how this buy figures actually happens in this video. Okay, Graham Healy over and out. Good evening, it's Graham Healy from Trade Canary, Australia and New Zealand. And tonight's session, what I'm going to go over, and we'll just have a look at this here. This is the lead advertising for it. I'm going to go over asymmetrical risk for your trading program. Now, the list I've got here, if you've got, say, 30 trades in your portfolio and 20 of them are losing trades, but you have 10 winning trades, I'll show you how you can have an 80% gain out of that, and you'll discover how to profit from only 30% winning trades in your portfolio. Now, I've done some handwritten notes, and I will bring that up now. Let's have a look here on the PDF file. Right, now let's open this up for you. And I'll reduce it down a little bit. It looks a little bit too big. Whoop, that went too far. So we'll just probably about there. Now, what I'm going to do, this is Friday the 4th of 7th. And so I handwrite my notes. I can do it on the computer and all that, but I think handwritten notes, for me, as soon as it comes to me, I'll write it down. So, okay, there's an analysis here of 30 trades. And in those 30 trades, you're using about a risk factor of $150 per contract. In other words, if I'm doing a call contract or a call or a put, but they're mainly calls, puts you usually use for insurance against, trade going downward, actually. But we're mainly looking at trades in an upward direction. Anyway, one call contract. If you've got a small account, you're only doing one contract at a time. If you've got a large account, well, you can do the same thing, but you just multiply them by 10 or 5 or whatever contracts. So in this case, we had 30 trades, and in those 30 trades, we paid about $150 per contract to run 30 trades at the same time. In other words, your portfolio has got 30 trades live in it. So, at the moment, my portfolio's got about 30 trades. So I'm just basically reproducing what I'm doing at the moment. And I'm doing it off a very small account. I only started with 1,000 Australian dollars, and it's fluctuated up and down from about 1,000 to 5,000 in the account. And I'm only looking at, people who are just raw beginners, and I'll take you through the necessary education to get you up to speed there. I mean, I've spent 2 years studying about options and all the different strategies and what have you. And what I've decided to do is just do a beginner's course over about 12 weeks. You can sign up at, Trade Canary Australia and New Zealand.com. And the course is about $500 or 4 payments of $150. And you can learn the basics. You can start your own account on a very minimal amount, like, as I say, anywhere between $1,000 to $5,000. And then when you're confident enough, you can purchase the Trade Canary software. That's around about 6,000 US or close to about 8,000 Australian. And that gives you access to a professional hedge fund data analyzing system that filters about 11,800 companies on the New York stock market. And it processes something like probably, millions of data points, if not billions of data points, to reduce it all down to a single executive summary page on particular companies. Now, that's not the purpose of this video. I've got other videos there on my website that explain, Trade Canary. But if, say, for instance, you're like, I'm semi-retired, I've got a part pension income, so I'm looking for another income stream that I can add in where I don't have to go working in a business like I've done before, although I'm still doing that. You might be working full time. I don't know. So this is just this video is to show you that you can have 30 trades in a small portfolio and still make profits of up to 80%. And as I go through this, you'll realize how it works. It's a numbers game. However, it depends on what information that you're obtaining to make informed decisions. Now, with all these videos, I'll just put a special caveat. None of this is financial advice. It's simply education advice for people who are looking at trading in the stock market on options and or shares or both. And other videos that I've prepared sort of go into, the ABC of starting up and what have you. Now, you can start a trading account and you can just do the beginner's course. You can follow trades that I'm doing as a learner, initial learner. And then as you get confident, you can then purchase the Trade Canary's software. But as I said, it's around about 8,000 Australian dollars to do that. But if you're not ready to do that yet, you can sort of crawl before you can walk, and then you can walk before you can run. And in this business, the more education you have and the more mentorship you have to get a hold of just a basic system is the best way to go. That way, you're consistently winning trades and you're not making ridiculous decisions based on emotion. Now, we've taken the emotion out of it by supplying you with the data. And as I say, I'll go into that in other videos, but let's just go through this. The whole theme of what I'm talking about is called asymmetrical risk. In other words, we only risk a small amount to gain quite a large amount. So here we go. The analysis of 30 trades at $150, that's the risk. That's one call contract is $150. So you'd maybe have 30, you'd have 30 contracts in a portfolio of 30. So 30 by 150 equals your portfolio would be worth about 4,500. Now, this is an illustration. You might only have 10 trades there, so that's 1,500. Right now, I'm just talking, this is US dollars, right? Now, if 10% if only 10% of those 30 earn $1,000 a trade. In other words, if out of those 30 trades, only 10% gain you $1,000. So you've put in 150 in a call. It might be 3 to 6 months in time. And then the trade starts to pick up. The company starts to go to the roof. And, it starts to gain money, or as they say, in the money. It starts to become in the money, and then at the appropriate time, you sell that particular contract. So let's say the average would be about $1,000, sometimes 400, 500, 600, but around about 1,000, 800 to 1,000 is a reasonable sort of trade based on a contract around about 150, right? So if only out of your 30 trades, only 10% earn $1,000 as a winning trade. So I'll go down here. That means 3 by 1,000 equals 3,000, right? So 3 by 1,000 equals 3,000. 10% of trades, which is 10% of trades, you've got 30 trades, and 10% of 30 is 3 trades, right? So now, if you've got 20% of trades and that earn $1,000, that means you've got 6 trades out of the 30. 20% is a fifth of 30 is 6. 6 trades by $1,000 equals $6,000. All right. So this is just working out percentages based on the amount of trades that you've got and the amount of winners that you have out of the 30 trades. So now if you've got 30% of the trades that are winners and you earn $1,000 a trade for 30 of them, that means 10 trades by $1,000, and that equals $10,000. So, just depends. These figures may vary a bit, but I'm giving you a little bit of an idea. So now let's have a look here. 30 by 150 per trade per contract equals 4,500, right? So if you've, the losses, which means what zeroes out, 30 at 150 gives you, that's how much is in the account. And if you have winners of 10, which I've said here, this is a 30% one, and you only have winners of 10, buy and you win, gain $1,000 per winning trade, you wind up with $10,000. Right, now we just go on to page 2. So the winners, which is 10 trades, buy $1,000 per trade, that's $10,000 profit, right? Your original investment for the 30 trades was $150, which is basically your portfolio value of $4,500. So out of the $4,500 that you've put into the portfolio by buying 30 contracts, option contracts at $150 a contract, that means you've your float basically was 4,500, but out of those 30 trades, you had 10 trades that actually made money, and those 10 trades made $1,000 each to equal $10,000. So when you look at this here, the $10,000 over the 4,500, the ratio, the win ratio there is 2.22 to 1, or a ratio of 2 to 1, right? So I've made $10,000 there. My float was 4,500, which represents 30 trades. This represents 10 winning trades. The profit ratio there is 2 is to 1, 10,000 over 4,500. That means if I put 4,500 into my trading account, and if I win in only 10 trades, in other words, only 1/3 of them is winning trades. The rest can actually what they call zero out. You actually lose that money. So out of 30, 1/3 are winners, 2/3 are losers, right? And that means you can lose 20 out of the 30 trades and still double the money and still make money. This is called asymmetrical risk. Important. The important caveat there, the risk is only $150. So whatever amount you've got in your trading account, you decide that, okay, I've got $5,000 in the trading account, I'm going to do a certain, say, 10%, 5% or whatever. And if it's $100 or $150, you do not, under any circumstances, go over that. So when you do a trade, all your trades based on what float you've got in your trading account, you do not go over that risk amount. When you do that, you then factor in what you call asymmetrical risk. So in other words, out of 30, 1/3 are winners. We're just assuming that's about the average, and 2/3 are losers. The process of that is actually double your money anyhow, and I'll show you the next step down. So page 3. So the total amount in your account, we'll just go through that carefully. So if you had $1,000 in your account, you'd say your risk factor would be, say, 10%. So that'd be $100 per trade. So you're not going to put any more than $100 per contract per trade, right? If you've had $5,000 in the account, you'd reduce that down to about 3% and make it $150 per trade. So the more money that's in the account, the less risk, or the smaller the percentage of risk factor. So say, for instance, you've been trading for, you know what you're doing. You've been trading for about 12 months and you've got 100,000 in the account. Now, I'm focusing on people with 1,000 to 5,000 to invest in their account. So, you'd be in this category. Most of the people that I'm dealing with are in this category. And after you're successful, say 6 months to 12 months or maybe 2 years, you might build up the account to 100 grand. But the whole thing here is that the same principle that you're using on a $1,000 account or a $5,000 account or anywhere in between is the same principles you use on the bigger account. You just scale it up or scale it down. So, whatever you do on the small scale, if you're successful on that, you'll be successful on the big scale. You've got to crawl before you can walk. You've got to walk before you can run. So here we go. $100,000 at 2% gives you about $2,000 a trade. So if you've got a $100,000 float, your risk factor per trade is around about $2,000, or you could make it $1,000, $1,500. So if I've got 100,000 in the account, instead of doing one trade at 150 or 100, I might just one contract at say $100, and I've only got 1,000 in the account, but I've got this account now is worth 100,000. I'm a bit of a bigger player. I reduce my risk percentage down to about 2,000 or whatever. So say, for instance, I'm trying to parallel someone who's got a small account with the same principle as someone who's got a larger account. So if the someone with the smaller account is 10% of that is $100, and they've got a bigger account, 2% of his account is $2,000 per trade. So he can afford, with keeping his risk asymmetrical, keeping the risk factors down low in proportion to what amounts in the account, he could put in, say, $1,000 in a trade. So the only difference between the small player and the big player here is this player here, number one, would only do one contract for $100, say a call option. And this player here, if he did, say, if he put forward $1,000, that's just 10 contracts. So each contract that you do for a call is it actually controls 100 shares. The underlying asset is the shares. So one option contract equals 100 shares in basically the underlying asset, as I say, is equal to 100 shares. The contract is over 100 shares, right? So that contract over time is a legal document controlling 100 shares for that duration that you've got the option contract for. So you can see the person here with $100,000, he might have started with 1,000, worked the portfolio up to 5,000, then he worked it up to 50,000, then he worked it up to 100,000. It could take a year or two to do that. You may, get some really good trades and do it a bit quicker than that. But I'm just giving you the idea that the proportionality of trades from small portfolios to big portfolios, the principles are exactly the same to keep it asymmetrical risk. So here we go here. This bigger portfolio, his latitude for what he can put on a trade would easily be up to $2,000. So if he's doing the same trade as this guy is, the small portfolio, he's only doing one contract. That's $100. But this guy can do one contract by 10, which equals $1,000, or he might do one contract by 20, which equals 2,000. So proportionately, he is governed his portfolio with the same asymmetrical risk factor. So, as I say here, if I use the same principles on the bigger account, i.e. 2/3 lost, 1/3 won in trades, each trade, say, I'm just giving this another, I'm saying 1,500 risk. 10 by 1,500 equals the profit return is the same ratio. So 10 I'm not 1/500, I'm just by 1,000, say this was that figure there. I should have written in 1,000 while I was talking up there, 1,000. If he bought 10 contracts, 10 call contracts worth $100 each, so because he's got a bigger portfolio, the $100,000 guy, he's actually purchasing 10 contracts instead of the smaller guy up here who's only purchasing one contract. Now, as an example, I rarely do more than one contract because my account's worth about $5,000, right? So I will only do one contract. I've done multiple contracts on shares that are very cheap, contract shares that are very cheap, but generally it's all around about $100, $150 for me. So that's what I'm trying to explain here. So each trade is cross that 1,500 out is actually, I've reduced that down to average of 1,000. So his profit return on those 1,000, if he's won $1,000 and he's done 10 contracts, he gets $10,000, right? He spent $10,000 on the initial contracts. I hope that's reasonably clear. Now, if that, let me start again. Just up here, I confused myself there a little bit. So if they've got 10 winners, that's what I'm saying. If this guy here who's winning $1,000, he's put, let's go, okay, it's $100 a contract, and this guy here, out of that $100, he actually gains 1,000. So if he's putting $1,000 in, that means he's got 10 contracts worth $100 each. So if that contract gains and then gets a profit of 1,000, that means he will get 10 by 1,000, which is 10,000, right? Now, 10,000 by 10 contracts is $100,000. I hope that's relatively clear. So now, so on the $10,000 trade account, 2/3 of what he's got in his account, he lost 1/31 of 30 trades. Given the big account simply had the same 30 trades, but instead of one contract, they bought 10 contracts. So the smaller trader's just buying one contract at a time at $100. But the bigger trader, because he's got more money in his account and he's already looking at only 2% risk of the 100,000, which can range between 1,000 to 2,000, he says, okay, I won't risk any more than 1,000 to 2,000 in every trade that I do. And he decides, okay, on the average, I'm just going to do 1,000. So instead of one contract, he bought 10 contracts. So based on his 2% of 100,000, which equals 2,000 maximum risk per trade, but let's say he's only going to, for the sake of the exercise, use 1,000 per trade. So 1,000 over 100,000 is 1%. So getting back to that other section up here where I talk about that, that can be 2%, that can be 1%. So 1% is 1,000, 2% is 2,000, okay? So where are we? So we've got, yes, we're down to here. Yes, okay. So if you put 1,000, which is his asymmetrical risk on a $100,000 account, it winds up being his 1% is risk factor. So I've written that there. Maximum risk per trade, 2,000, he's made at 1,000, which equals 1%. Now, 1/3 of 30 trades equals 10 trades. Now, because he's got 10 contracts, instead of winning $1,000 or gaining 1,000, he's going to get $10,000 because one contract equals, in this case, we're illustrating that one contract is winning $1,000 in a trade that's profitable, right? So if he only gets 10 winners out of 30, trades that's in his portfolio, you know, the other 20 don't make money, they go to zero. In fact, he will win, when you look at it this way, 10 trades by $10,000, he will gain $100,000. So that the smaller trader, he will gain 10,000 because he's only got one contract per trade that's winning $1,000, and that's 10 trades by 1,000, it's 10,000. But this guy has got $1,000 in each $100 trade. If you could, instead of $100, he's multiplied it by 10, which means he's put in 1,000, which is 10 contracts. So each contract is worth $1,000 instead of 100. So the net result is when he wins the 1,000, it's multiplied by a factor of 10. So he has 10 trades with $10,000 per trade, and that will equal, $100,000. So he'll gain $100,000, where the smaller trader, based on his, capital trading amount, gains $10,000. So out of his portfolio, this is a $100,000 man. Out of his portfolio, 20 of the trades were basically lost. So 20 of the trades that he paid $1,000 for wound up zero. So if he's got 30 trades and he's putting $1,000 down in each trade because he's got a $100,000 float, so 30 trades is $30,000, right? So $20,000 by $1,000 he's put, no, we'll correct that. He's put $30,000 in, $20,000 by $1,000 trade. So $20,000 didn't gain anything. They returned to what they call zero. They didn't make money. They're a loss. So he's lost $20,000, right? But out of the $10,000, those actually won at the end of the trade $1,000 ahead by 10, which is $10,000. So to make it a bit clearer, that was 1/3 of his portfolio. 10 by $10,000 gained is 100,000. It sounds a bit confusing, but so in other words, the $100,000 account lost $20,000 because 2/3 of what he put into the account at $1,000 a trade lost $20,000. But the 10 trades that he did that gained $1,000, that actually gained $100,000. So his original float lost 20,000, which is 80,000, down to 80,000, but he won 100,000. So that's now, that account is now worth $180,000. So the recap is this. On the 100,000 trade account, the total gain was 100,000, which was the original float, minus 20,000, which is the loss, plus the 100,000 gain. So he's actually, his account now sits at 180,000, which is a plus 80% gain, right? So the bigger player has sustained a loss on 2/3 of his portfolio, but he's sustained a win on 1/3 of his portfolio. The net result of that was he only lost 20,000, but he gained 100,000. So the reality is he gained 100,000 on his account. 180,000. So he gained 80,000 plus 80% on his original $100,000 account. Now, on the $5,000 trading account, we'll just do it similar. 1/3 of them is winners on the 30 trades, which means he had 10 winners. 2/3 lose of the 30, which means he has 20 losses. Assume that each contract's worth $100 spent per contract. So 20 by 100 equals a $2,000 loss. This is the person with the $5,000 account. So all I'm trying to say is the person with a $100,000 account, it's all proportionately relative to the same as the person with the $5,000 account. So assume $100 spent per contract, 20, which is the losers, by 100 equals $2,000 loss. And he had 10 winners that won $1,000. In other words, the contracts made him $1,000 each, only 10. 20 lost, 10 winners, a total of 30. That means 10 by 1,000 is a $10,000 gain. So therefore, the $5,000 float lost $2,000, but he gained $10,000. So the net result of that is 5,000 minus 2 is 3 plus 10 equals 13,000 is the new float. So we take off his original amount that he had there, and he's made an $8,000 profit. 8,000 over the 5,000 is 62.5%. Now, I know that sounds a little bit complicated, but you just go through those figures and it basically boils down to this. The most important thing with all this is that you calculate your calculated risk and you don't go over it. So if I decide that my risk is $100 to $120 per trade, which it is on a $5,000 account, maybe $150 at the most, doesn't matter what the trade is, I will not spend over that. I will make certain every time I'm trading on every single trade that I do not risk any more than that $150, $120, $100, around about that. The average would be about $120 to $150, just like I've said earlier on in this. So when you do that and you make gains, it forces you to make wise decisions on your trading portfolio to make money and not throw money away. So by factoring it like this in an asymmetrical risk protocol, you can have basically 70% of your portfolio losing trades and only 30% of your portfolio, where that's on average. I've done 1/3 winners, 2/3 losers, so that's 66%. But just say on it, just to round the figures up, 70 losses, 70% of your portfolio are losing trades, and only 30% are winning trades, but they're reasonably winning trades. In other words, they'll make, say, in a smaller portfolio, and the average would be about $800, maybe $1,000. And as an example, one of my first trades that I did was Morgan Stanley. I think I did an earnings trade or something on that, and I put in about $120, and within, I think it was about 3 weeks, that made $800. Recently, I'm kicking myself over the Goldman Sachs trade that I did just recently. I did a call for, I think, 745 share price, and I bought the call right at the bottom of the curve when President Trump announced the tariffs. And last week, that call started to wind up being what they call in the money. And that $120 it was 93, that's right, 93. It was only about 100 American dollars that I invested in that particular one, keeping my risk ratios into that limit. Then that wound up being about last week sometime, wound up being about $400. And because it was at its all-time high, I thought, well, I will sell that and reinvest it in couple other trades. But I'm sort of kicking myself that I did that, because in the next 2 days, Goldman Sachs, and I've gone into that in other videos, actually it broke through the roof. It broke through the barrier and it went to an all-time high. And the value, I think, as of today, the Friday, I think Friday the 4th, the value of that call on at 7.45, I think Goldman Sachs is around about 7.20 at the moment. Started off around about 400 when I bought the calls. That's now worth 2,000, close to 2,000 US dollars. So in other words, if you invested that 100 US dollars around about Easter, so you got East, January, February, March, April, May, June, July. So Easter, May, April, May, June, that's about 3 months. If you invested that $100 then, your $100 American dollars would now be worth 2,000. So that's just one example of one of those 10 out of 30 trades that can go through the roof in your portfolio. So this is how you've got to run the figures, right? So okay, so I'm just continuing on there. So therefore, the $5,000 float minus your $2,000 loss, which basically winds up being the 10 trades out of the 30. The 20 trades out of 30 are losses and 10 trades are winners. You still wind up with an $8,000 profit. So in other words, you can lose in a portfolio of 30 trades, you can lose 70% of them. In other words, they reduce to nothing, and 30% of them are winners, and you wind up you're doubling your money of your original float that you've got in the portfolio. So when I go to the bottom line here, and I hope this hasn't been too confusing, the bottom line is this. Just, I want you to burn this in your memory, and you can go over this PDF file that I've done and have a look at it a couple of times. Provided you stick to your risk management or your max risk based on your trading account. I'll just repeat that again. The bottom line is provided you stick to your maximum risk based on your trading account float, as I give the example above, $1,000 float at 10% is $100 risk per contract. And these are just estimates. $5,000 float at around about 3% gives you $150 risk per contract per trade. If you've got a $100,000 account and you've got 2%, you say, okay, 2%, it gives you $2,000 to play with on a particular trade, which is this one here on the $1,000 account. Simply, that is 10 contracts rather than one. This guy here be only doing one contract at a time. This guy here could afford to be doing, he could be affording to do 20 contracts. 20 at 1,000 is 20,000, right? Or probably the $100,000 guy would more conservatively use about 1% of his total float, which is $1,000 risk. So if he's using $1,000 risk, this guy here on the smaller account is only putting in one contract. This guy here is putting in $1,000 worth of contracts, which is 10 contracts. So 10 by 100 equals 1,000. So his risk factoring, the bigger account to the smaller account, the risk factoring is the same. It's just you gear it up a little bit according to what the float is in your trading account, right? Now, on a total of 30 trades, only 10 win and 20 lose. That means a third, which is approximately, a third's 33 and a third, but that's, I'm saying approximately 30%, and 2/3 lose, which is approximately 70%. In other words, in a portfolio, 70% of your trades can lose, big deal, over time. And if only 30% win, and when they win, they make those wins of 800 or whatever out of this if you're putting in 100. Now, I've done this and I know that is more than possible, provided you make quality informed decisions on the trades and don't just throw anything at any silly trade. So therefore, the account of 5,000 gained $8,000 doing this, but lost 70% of the trades, right? This is asymmetrical risk. It sounds like a little bit of, it does sound a little bit confusing, but when you work through the figures and realize when you just multiply it out, because you're holding your amount of money that you're putting into the contracts at that fixed amount, and you're not throwing all sorts of money around the ridges, you will factor it into an asymmetrical disproportionate. In other words, your wins will be big and your losses will be small, but even though you're losing on bigger trades. So that, you just imagine a set of scales, and when you do it this way, you're setting the scales up in your favor and the losses down the other way. I might put a set of scales on the video when I do it. So the $5,000 account gained $8,000, which is 62.5%, and the $100,000 account gained $80,000, which was 80% on the original float. Now, I mean, this is just giving you a broad brush idea. At the end of the day, you will be a winner, even though you've lost 70% of those trades. And it's asymmetrical because the losses are only the $100 that you're prepared to lose because of your risk management policy, which is critical. That is critical. I'll repeat it again. Risk management policy is critical. But the winners can be substantial, and in this case, your winners are basically 10x. So I've put $100 in, and I've done a 10x gain. That doesn't always happen. It might be a 5x gain. The minimum gain before I sell any contract's got to be at least 2x to 4x. So, 2x means that if I've put in 100, it's made 200. You can, I can get rid of that one or sell it if I want to, or roll it. Or if it's made a 4x or a 5x gain, it's like that trade that I just spoke about just recently, Goldman Sachs trade. I mean, that's, I think it was 150 in for that trade. It's now about 2,000. So that's, what's 100? It's about a 10x to 15x. So 10x is 1,000, 2,000, 20x. I think it's about 15 to 18 times the amount you invested. Now, you can imagine being in some sort of bank and they come back and you say, oh, look, you just made $2,000 interest over. I've even that $100 you put in your bank account, we're going to pay you $2,000 in 3 months' time. That's what I'm talking about. Now, you get these trades right with the right training principles or trading principles behind what you're doing. And of course, Trade Canary facilitates that. And the basic training that I'm doing is, look, what I'm trying to do is just get people who've got, a moderate amount of money to wind up with a trading account, to start trading in that trading account and have a couple of wins, and realize that when, you've got, as I say, 30 trades at once, or may not have 20, but say I'm using the figure of 30 because that's exactly what I've got in my account, that you're not going to freak out if 70% of those don't make money, but 30% of them do, and they make a reasonably substantial amount of money. So they're making, up to $1,000. Sometimes they might make more. Sometimes they might make slightly less, but let's average it out around about $800 to $1,000. You're in the winning team no matter which way you look at it. So that's the principle of asymmetrical risk. I hope that helps. And if you have any questions, just go on to Trade Canary Australia and New Zealand, and when you're a member, you can go onto the chat site there. We've got a group site, and you can ask various questions, and I'll clarify that. So we'll just finish off this video, and I hope that helps. So I hope I wasn't too confusing in some of those areas there. There may be some nuances that I haven't added in there, but that's the principle. So just finally, I'll just emphasize this one more time. Do not, under any circumstances, do not have your risk capital not worked out. In other words, do not risk any more than those percentages that I've said there. If you've got $1,000, you're only going to risk 100. You got 5,000, maybe 150. You got 100,000 in the account, your maximum's 2,000, and probably 1,000 is safer. Maybe hit it, go anywhere between 1,000 to maybe 1,500. And you can afford to do that based on the ratio of that 70% of the trades you do are going to be losers and 30% are going to be winners. But if they're winners, they're going to win anywhere between $800 to $1,000 if the trades are studied carefully before you do them. And Trade Canary actually helps you along that way. Okay, Graham Healy over and out. Hope that helps. And we will be giving you more information, more educational videos as we go along. Thank you very much. All right, Graham Healy from Trade Canary Australia and New Zealand.com. I hope all that made sense. The bottom line with that video is simply this. You can have a portfolio that's losing 70% of the trades. In other words, 70% of the trades don't make anything, and the $130 or $150 that you put in per contract winds up being zero. In other words, you lose that $130, but 30% of the trades are actually winners, where you're making at least around about $1,000 per winning trade. And the secret is, of course, that is what they call asymmetrical risk. In other words, the odds are in your favour if you stick to the plan, if you stick to what I've just said on this particular video. Now, this is correct trading education. All the professional traders, they know the asymmetrical factoring. So that's why, for instance, Eric from Trade Canary, his hit rate is 98%. And so how he can bring that hit rate up is we're using Trade Canary as our professional hedge fund analytical data analytical tool. So that's how you make the difference, and it's a very important factor that you stick to your risk allocated risk management. In other words, if you've got that $1,000 in the account, you only put $100 in per contract. If you've got the $5,000 account, you might go to $120, $150. If you've got the $100,000 account, well, you can flex from $1,000 to $2,000 per trade. That is in proportion to what money you've got in the account, or what float you've actually got in the account. So I hope that makes that clearer. It's a very important fact. It's a very important thing before you do any trading, that you're actually only using a certain amount of the money or capital in that particular account. The object of the exercise, of course, is to build up the account. And as you've seen by these figures, you can increase the account by 80%, even sometimes more, maybe a little bit less, but around about 80% using the 70-30 rule. In other words, 70% are losers and you only have 30% as winners, and you take that time over 3 to 6 months, maybe 12 months, and you come out with doubling your account value. It's a pretty good way to do it, but you've got to be disciplined and follow exactly what I've said in this video. Okay, Graham Healy. More information, of course, is on Trade Canary Australia, New Zealand.com, and I have a beginner's course there, and if you sign up for Trade Canary, the software, they also have support, the bigger picture support as well. But I'm just doing the simple beginner's course. It's only 500 Australian dollars, or you can pay 4 payments of 150 and allocate yourself about 12 weeks to go through that, to know exactly what you're doing as a beginning trader. So you've got to crawl before you can walk, and then you've got to be walking before you run. Okay, that's Graham Healy over and out. Have a great day.